During the recovery following the financial crisis, it's been China that's carried global growth, but the world's second largest economy has slowed down as a recession and debt crisis in Europe weighs on China's exports. The country's manufacturing sector contracted in September for the second straight month. What's more, orders for new exports hit a 42-month low in September. At the same time, demand for merchandise domestically seems to be sagging while authorities try to blunt the blow of a housing bust. So what's the outlook for China? How serious is the slowdown? And what does it mean for investors? Joining me all the way from London is James Weir, co-manager of Guinness Atkinson's Asia-focused funds. James, welcome to the Wall Street Report. It's so great to have you.
Hi, good to be here.
So what really got me thinking about this segment were comments by FedEx's CEO warning that China's export economy is actually much weaker than people think. What's your take on that? What's your outlook for growth in China? And what's the risk growth will actually clock in lower than the 7.5% the government is targeting?
I think the medium-term target for growth there is between 7 and 8%. Now, I think if you think of the way that China works, you know, they're quite motivated by targets. Wen Jiabao is coming up to the handover, and I'm sure that the official number will be above 7%. Having said that, if you look deeper into some of the underlying economic indicators, if you look at M2 growth, if you look at auto sales, if you look at electricity production growth, you can see that growth is definitely slowing, but it is not as bad as some of the bears are making out. So I think 7% is probably a reasonable estimate.
So is that a hard landing or a soft landing? And how long do you perceive this slowdown in China will persist? Are we looking at a new normal in China where perhaps that double-digit growth that we saw is behind the country?
I think so far we've certainly seen a soft landing in China. Now, the question as to how long it persists, I mean, certainly there is a cyclical element to this slowdown, but there is, as you say, also a structural element there. I think in terms of the cyclical element, we can already see that the monetary stimulus is starting to have some impact. Housing pre-sales have started to pick up. The construction part of the economy is so important, and we think construction is going to turn around. We can already see cement prices begin to pick up, and we can see that thermal coal prices are starting to bottom out. In terms of that structural element, it's fair to say that China's demographic dividend is coming towards the end. However, this doesn't necessarily mean that they're going to be in for an extended period of slow growth. It doesn't mean they're going to get caught in the middle income trap. But what it does mean is that they've got to shift from, you know, direct stimulation and from a focus on exports to more productivity-based growth, and they've got to focus on the kind of industries that can give them that sort of growth.
How do you view the policy response by the Chinese government to both the housing sector and the slowdown in general? We did see the Chinese government dump some money into the banking system directly, but would you expect the government to implement more conventional measures like lowering interest rates and bank reserve requirements?
So far, I think they've been behind the curve in terms of their policy response, but they've been very focused on making sure that when growth comes back, it doesn't drive a new cycle of inflation. But now the monetary policies that they have been making are starting to have an impact. We can see the impact in terms of loan growth. And now we've started to see a fiscal policy response as well. They've announced a new package for some new subway lines, and the affordable housing program is still ongoing. And we think that, you know, the build up to this handover has been very important, and they want to make sure that that goes smoothly. And in terms of that, they want to see growth back on track for the third and the fourth quarter.
As with the past installment of quantitative easing here in the United States, China recently voiced concern about QE3 and the fact that that might spark inflation in their economy. My question is, does U.S. monetary policy handicap China's ability to stimulate its economy, or this time are inflation fears unfounded given that China's economy is slowing, and the last time the U.S. did an installment of quantitative easing, China's economy was pretty robust?
I think that's a fair point. Things are definitely different this time in terms of growth inside China. If you look at the structure of inflation in China in recent years, it really has been food prices which have been the driver of that. Now, that isn't related to quantitative easing in the developed world. That's particularly related to the hog cycle in China. Now, you've got to remember as well that China has capital controls on, and they control the currency and sterilize inflows. So the printing of money in the US doesn't directly impact upon inflation in China. However, it does create some pressure for the currency to appreciate. So on the one hand, it may create some pressure on the currency to appreciate, but because of those capital controls, we don't see it's a big issue. Really, inflation comes down to what's going on inside China.
So how's the slowdown manifesting itself in the financial economy? I have in my notes that borrowers are having difficulty making payments and the number of bad loans is rising. Is this a serious problem for China's banking sector?
Well, I mean, whenever economic growth slows, then bad loans are going to rise. But if you look at the major Chinese banks, their non-performing loan ratios are actually exceptionally low by international standards. The Tier 1 capital ratios are reasonably high, so these are well-capitalized institutions. I guess that the issue comes more at the micro level, where you have small businesses that can't get loans, and it is fair to say that those big banks prefer to lend to the state-owned enterprises than to the kind of mom-and-pop enterprises. But we don't see this as a particular issue.
What's your take on the state of the property sector in China now? I mean, that's really been the sector that's been linked to the prospect of a hard landing. What's your sense?
I think that it's beginning to turn around. We can start to see that in terms of the micro indicators, that the pre-sales by the property developers picked up quite nicely after the kind of the monetary easing in China started to kick in around the second quarter of this year. And what hasn't really kicked off yet is construction, and ultimately the developers' inventories are going to be run down over the next 12 to 18 months, and they're going to have to start building homes again. And we can, as I mentioned, we can start to see that in cement prices a little bit, but it still needs to spread out. This is a really crucial time of year going into the third quarter. This is when construction traditionally starts to kick off again. So we'll have a better feel for that towards the end of the year. But so far, the signs are good that the supply side is starting to kick up.
I want to talk about a recent incident of unrest in a Chinese factory, and this is a particular factory that actually makes electronics parts for Apple devices and Dell products. And for viewers who aren't aware, some of these factories can be like small cities, right? They could have 79,000 people, which is the case with this factory. Apparently, workers are unhappy with living conditions. Unlike the U.S., you go to work, you go home. I guess here in China, or with this factory, you actually live there. So my question is this incident emblematic of a greater shift towards demand for better working conditions and higher wages? And how does China balance those demands at a time when their manufacturing economy is slowing?
I think that those type of demands are actually reasonably high on the agenda of the Chinese government. They have been making efforts to improve wages in those kind of manufacturing companies. In fact, some of the local authorities have actually been mandating wage rises last year, this year, and next year. Now, what that means is that's going to put the margins of those manufacturers under pressure, and some of those are quite low margin businesses anyway. Now, it comes back to the point I was making about productivity. The Chinese want to improve productivity in their economy, and actually they would not be unhappy if some of the lower end stuff, some of the electronics assembly, some of the textiles actually left China and went to places like Vietnam, potentially Myanmar. So actually, the Chinese have got a grip on this.
What about this new rift between Japan and China that has come about ever since Japan purchased that string of islands in the East China Sea? How is that rift affecting China's economy, and what are the implications for global trade?
I think that, frankly speaking, I think the implications are minimal. I think this is a pretty straightforward dispute over natural resources. You've seen similar disputes between China and some of its neighbors across the South China Sea, where they have claimed for their own a large area of kind of prospective for fossil fuels, that is. If you look at the kind of trade flows between the two, about 7% of China's exports go to Japan, and about 10% of China's imports come from Japan. So these are major trading partners. Clearly you've got historical enmity between the two nations that dates back to the war. So
James, oh, go ahead. Sorry, finish your point.
Sorry, I think it's kind of politically expedient at the moment, but I don't think this is going to lead to a extended conflict.
So what does this all mean for investors in China? The Shanghai is sitting at multi-year lows. Is China a good value right now for long-term investors, or in the short term, is it actually a value trap?
I think China is reasonably good value at the minute. I think a lot of the slow growth has been reflected in equity prices, and I think that there are early signs that we're starting to come out of this. But I think it's like investing in any developed market. The capital flows from the developed world can tend to dominate the real value, but that can create overvaluations. It can create opportunities when investors leave. I think our approach has always been to take a long-term view. We look to invest for a minimum of 3 years, and I think that's the right way to go about investing in developed markets.
All right, James, thanks so much for coming on the program and sharing your insight. I so appreciate it.